Welcome back, everyone. Sean Stevens here again with Metroplex Mortgage Services and another divorce mortgage planning video quick tip. Divorce often brings unique mortgage challenges, such as income qualifying, equity buyouts, contingent liabilities, and timing of court ordered support payments. Without the right strategy, these factors can derail financing. Divorce mortgage planning helps prevent surprises and keep the process on track. In today's post, we will break down some of the most common challenges divorcing homeowners face and how proper planning can make the difference between loan approval or denial. And don't forget about our free second opinion service, which provides family law attorneys and divorcing homeowners with immediate answers when these challenges arise during settlement negotiations or even post decree. As a refresher, credit scores used in mortgage lending are primarily calculated using FICO scoring models developed by Fair Isaac Corporation. The three major credit bureaus, Equifax, TransUnion, and Experian, do not calculate scores themselves. Instead, they collect and maintain credit history data, which FICO's proprietary models analyze and convert into your credit score. Most mortgage underwriting continues to rely on FICO-based scoring. Those scores are generally weighted across 5 core categories. Payment history, on time versus late payments, makes up 35%. Amounts owed, balances and utilization is 30%. Length of credit history makes up 15%. New credit, inquiries and recently opened accounts makes up 10%. And your credit mix, such as installment versus revolving, also makes up 10%. In divorce cases, the what happened recently items, late payments, balance spikes, and inquiries that lead to opening new debt are common areas of concern for financing because they often surface precisely when a client needs underwriting approval the most. It is also important to note that a credit score alone does not guarantee mortgage approval. Underwriters evaluate minimum qualifying credit standards holistically by taking into account factors such as recent delinquencies, patterns of late payments, disputed accounts, public records, inquiries, and the type of accounts involved, such as individual, joint, or authorized users. These variables can determine whether a refinance is possible and whether all parties remain in compliance with the terms of the marital settlement agreement. And a common question we receive is, why are consumer credit scores not the same as mortgage credit scores? It is very common for a client to have multiple credit scores at the same time. This is not a system error. It is a result of different scoring models, data sources, and use cases. Common reasons consumer-facing scores different from mortgage scores include use of different scoring models. For example, FICO versus Vantage score, or different versions within each model. Variations in bureau data. One bureau may report accounts or balances that others do not. Timing differences as balances, limits, and payment history update. In mortgage credit report, scoring versions can differ from the versions used for credit cards or free monitoring tools. If your client is negotiating an equity buyout or planning a refinance timeline, the only score that matters is the score associated with the mortgage underwriting channel they will actually use. So, what is the mortgage qualification relevance to divorce planning? Credit scoring affects 3 immediate divorce mortgage pressure points: pricing and program access, debt to income ratios, and realistic settlement terms, because refinance and purchase approvals depend on the underlying credit report that supports the score. When a settlement requires a refinance to remove a spouse or access equity to buy out their interest, it is best practice for credit report analysis to occur before final agreements are signed and not treated as post-decree cleanup items. And it is a drafting tip. Use the right credit conversation during MSA negotiations. If the negotiations rely on a refinance or new purchase, avoid basing decisions on consumer-facing credit monitoring tools. Instead, anchor discussions to what is actually reported in the credit report, how each debt will be treated for mortgage qualification, and what score improvement is realistic based on specific actions such as paydowns, removals, or deletions. We can model these changes up front before settlement terms are finalized, so financing plans are built on underwriting reality rather than assumptions. Do you need help interpreting a client's credit qualifying ability? Our second opinion service is here to assist, provided at no cost to support your case strategy. A second opinion service review includes a full review of the client's credit profile, guidance on how each account type will be treated for mortgage qualifying, simulated credit score and debt to income ratio changes before decisions are made, identification of hidden mortgage qualification risks, and recommendations on how to align the marital settlement agreement with mortgage guidelines. Request your confidential review today to protect your client's financing options and avoid last-minute surprises that disrupt settlement terms. Remember to just call, text, or email to schedule your confidential loan consultation, and let our divorce mortgage practice group go to work for you and your clients.